What is happening, crypto fans, and welcome back to Bitcoin Bulletin, your go-to source for the absolute latest and greatest in the digital asset space. The market is moving at lightning speed, and if you're not plugged in, you're missing out on the biggest moves. Today, we've got a packed show that you absolutely cannot afford to miss. We're diving deep into the complex world of whale activity, uncovering shifts that could redefine your investment strategy. Plus, we're exploring how the recent price action is creating massive opportunities in payroll solutions and examining the signals that might be hinting at a major market turn. You'll want to stay tuned for all of it. Let's jump right in. First up, we're tracking the giants of the Bitcoin world. Are they holding strong, or are they quietly shifting their allegiances to other major players? We've got the data on massive BTC transfers and what it could mean for the market. Get ready for some eye-opening insights. Next, we're looking at how Bitcoin's comeback is being hailed as a game-changer. This isn't just about price, it's about a fundamental shift in how businesses are paying their people, especially those who have been left out of traditional banking. We'll break down the innovative strategies making this a reality. Then, we're going to dissect a colossal transaction that sent shockwaves through the market. A single whale moved billions, and we're talking about the ripple effects this had as Bitcoin hit a critical price point. What does this massive sell-off tell us about the current market sentiment? And finally, we're examining the institutional confidence. After a massive rally fueled by new investment vehicles, are the big players starting to pull back? We've got the numbers on significant outflows and what it means for the stability of the market. Stick around, because you need to know this. Don't go anywhere. Make sure you smash that like button, subscribe if you haven't already, and hit that notification bell so you never miss an update. We've got all the critical info coming up right after this. Bitcoin's silent giants, holding power, shifting loyalties to ETH. Are the biggest players in Bitcoin playing a long game, or are they quietly diversifying their portfolios? This is the question on everyone's mind as massive Bitcoin whale movements come to light, revealing potential shifts in allegiance towards Ethereum. We're diving deep into the on-chain data that shows these silent giants are making strategic moves, with some transferring significant amounts of Bitcoin to exchanges while others are actively converting their BTC holdings into ETH. This trend could signal a broader sentiment shift among major holders, impacting the market dynamics we've come to expect. Context is key here. Understanding the behavior of these large-scale holders, often referred to as whales, is crucial for anyone looking to navigate the volatile crypto landscape. Their actions can trigger significant price swings and influence overall market sentiment. In this report, we'll unpack what these massive transfers and conversions truly mean. Let's get into the main details. A significant whale address, dormant for 12 years, recently transferred 500 bitcoins, valued at approximately $55.37 million, to Binance. This same wallet, which initially received 5,000 BTC when Bitcoin was trading at a mere $322, still holds a substantial 3,500 BTC, worth around $387 million. This suggests a strategic partial liquidation rather than a complete exit, indicating a long-term perspective on Bitcoin for a considerable portion of their holdings. However, the act of moving such a large sum to an exchange often precedes a sale. Adding to the intrigue, on-chain analyst Willy Woo has pointed out that Bitcoin's oldest whales, those with the lowest cost basis, may be contributing to the current sluggish price action. According to his analysis, it now requires over $110,000 in new capital to absorb every Bitcoin these early holders decide to sell, given their exceptionally low acquisition costs. This concentration of supply among these veteran holders means that even modest sell-offs by them require substantial market buying power to counteract, effectively dampening upward price momentum. Further amplifying the market's volatility, another major whale sold a staggering 24,000 BTC, valued at over $2.7 billion, over the weekend. This colossal sell-off directly contributed to Bitcoin's price falling below the $110,000 mark and triggered a sharp 2.2% flash crash on Sunday. The impact of such a large transaction cannot be overstated, as it immediately put downward pressure on the market. What's particularly noteworthy is the apparent strategy behind these sell-offs. The same whale that offloaded 24,000 BTC also moved a significant portion, 18,142 BTC, worth $2 billion, to a decentralized perpetuals platform, Hyperliquid, and converted it into ETH. This move aligns with a broader trend observed among several large holders who are increasingly converting Bitcoin into ETH. For instance, another whale recently sold 670 BTC, approximately $76 million, specifically to initiate long positions in Ethereum. This growing interest in ETH among major investors is particularly significant, especially considering Ethereum's impressive 220% surge since its low in early April. Despite these significant price fluctuations, the broader market sentiment remains relatively neutral. The Bitcoin Fear and Greed Index is hovering at 48, indicating a cautious stance rather than outright fear or greed. On the network's fundamental side, the Bitcoin hash rate is showing resilience, nearing an all-time high of 909 million terahashes per second, underscoring the robust security and operational capacity of the network. Historically, holding Bitcoin has proven to be a highly profitable strategy, with the asset being profitable on 99.1% of its days in existence. Yet, the market remains on high alert, with investors keenly observing every move made by these influential whales, as their actions continue to be a primary driver of short-term market turbulence. Audience impact. Investors are keenly watching these whale movements, with discussions on social media highlighting both concern over potential sell-offs and optimism about long-term holding strategies, while analysts debate whether this signals a true shift in power to Ethereum. But is this shift to ETH a sign of broader market rotation or just a temporary play? Stay tuned as we dissect the very strategies being used to navigate these volatile waters. We're now going to explore how Bitcoin's price recovery is directly impacting the adoption of crypto payroll solutions. Bitcoin's value recovery, a game-changer for crypto payroll adoption. Bitcoin's recent price surge isn't just making headlines. It's actively reshaping the financial landscape for startups across Asia, particularly in the realm of payroll. This remarkable recovery is paving the way for crypto payroll solutions to become a mainstream offering, empowering employees, especially the unbanked, and positioning companies as innovators in digital payments. We're diving into how this resurgence is fueling adoption, and the clever tactics startups are employing to mitigate the inherent volatility of digital assets. To understand the significance, let's recap. Bitcoin recently staged an impressive rebound, successfully testing a crucial support range between $110,700 and $111,000. This recovery is a vital signal for the broader crypto market, injecting renewed confidence among investors and hinting at potential upward momentum. All eyes are now on the $117,000 resistance level. Breaking through this could unlock further upside potential. For businesses, this price stabilization and upward trend are directly influencing how they manage their payroll operations. Now, let's delve into the core of the matter. The activity of Bitcoin, whales, those entities holding substantial amounts of cryptocurrency, continues to be a significant factor in market dynamics. Recent reports indicate that a notable Satoshi-era whale moved a substantial 3,968 BTC, valued at nearly $437 million, with a significant portion reportedly converted into Ethereum. Such large-scale movements can introduce considerable shifts in market stability and investor sentiment, often attracting increased regulatory scrutiny and posing challenges for smaller crypto-focused companies. Understanding these large-player dynamics is therefore essential for any firm aiming to effectively navigate the evolving payroll sector. The resurgence in Bitcoin's price is acting as a powerful catalyst, compelling fintech firms to accelerate the implementation of crypto payroll solutions. By integrating Bitcoin into their payroll systems, these companies are offering employees the unprecedented option to receive their salaries directly in cryptocurrency, effectively bypassing the traditional banking infrastructure. This is particularly transformative for individuals who are unbanked or underbanked, granting them access to financial services and opportunities that were previously out of reach. In today's competitive job market, the allure of potential value appreciation makes crypto payments an increasingly attractive perk for employees. However, the inherent volatility associated with cryptocurrencies presents a significant challenge that companies must address to ensure the reliability of payroll. To effectively manage these risks, businesses are adopting a range of sophisticated strategies. One primary approach involves offering compensation through stablecoins, which are pegged to fiat currencies like the US dollar. This provides employees with salary predictability, shielding them from the sharp price swings common in the crypto market. Another effective tactic is implementing mixed payment options, allowing employees to receive a combination of volatile tokens, stablecoins, or even traditional fiat currency. This flexibility empowers employees to manage their exposure to market volatility according to their own risk tolerance. Furthermore, companies are locking in exchange rates at the precise moment payroll is processed. This ensures that the value of the salary remains consistent, regardless of subsequent market fluctuations, thereby eliminating disputes and protecting employees from unexpected price drops. For their own financial health, businesses are also employing hedging strategies and diversifying their treasury holdings. This involves maintaining a balanced portfolio of both volatile crypto assets and stablecoins to cushion against sudden market downturns. Robust scenario planning, coupled with the establishment of contingency funds, is also crucial for ensuring operational stability and the continuous ability to meet payroll obligations even during periods of significant token value decline. Leveraging specialized payroll platforms and secure custodial wallets further streamlines the process. These solutions often automate currency conversions and ensure compliance with regulatory requirements, simplifying salary disbursement for both the employer and the employee. Cultivating a culture that emphasizes long-term incentives, where employees are paid in tokens that align their interests with the company's success, fosters greater loyalty and encourages a forward-thinking mindset. Finally, active crypto asset management, which includes tactical trading and strategic sector rotation, can help maximize returns and actively reduce the impact of volatility on company finances. These multifaceted methods enable startups to harness the distinct advantages of crypto wages while adeptly confronting the persistent challenges of volatility and regulatory complexities. Bitcoin's recovery is more than just a financial event. It's a transformative force for the future of payroll. Companies that embrace these crypto salary models are not only enhancing employee satisfaction and financial inclusion, but are also positioning themselves at the vanguard of digital payment innovation. As this dynamic landscape continues to evolve, the strategic integration of stablecoins and innovative payment strategies will be paramount in effectively managing volatility and ensuring the sustainable growth of crypto salaries. The future of work is undeniably intertwined with the ascendancy of cryptocurrency. Audience impact. Employees are expressing excitement about the flexibility and potential gains offered by crypto payroll, while businesses are cautiously optimistic, focusing on risk mitigation strategies to ensure stability and compliance. These innovative payroll strategies are crucial, but what happens when the market itself experiences a massive shakeup? We're about to find out. We now turn our attention to a colossal whale transaction that sent shockwaves through Bitcoin's price. A whale's 2.7B move shakes Bitcoin at $110K crossroads. The digital asset market is on edge as Bitcoin finds itself at a critical juncture, hovering precariously around the $110,000 mark. What's causing this tension? A colossal sell-off from a single whale, offloading a staggering $2.7 billion worth of Bitcoin, has sent ripples through the market, triggering widespread selling and pushing prices below this key psychological level. We're dissecting the immediate impact and what this massive transaction reveals about current market sentiment and potential future movements. Bitcoin's recent price action has been closely watched, with the $110,000 level identified as a pivotal point. A massive whale sell-off has now tested this level, leading to significant volatility and raising questions about the market's immediate direction. This event is occurring amidst broader shifts in trader behavior and overall market sentiment. Bitcoin has recently experienced a significant pullback, dropping below the crucial $110,000 support level and reaching lows of $108,890. This correction follows a period of upward momentum where Bitcoin had briefly touched $117,000 just days prior. The primary catalyst for this downturn was a monumental transaction executed by a single, large-scale holder, often referred to as a whale. This entity liquidated 24,000 BTC, a staggering amount valued at over $2.7 billion, over the course of the weekend. This massive sell-off exerted considerable downward pressure on the market, triggering cascading sell orders from other participants and intensifying the price decline. The market's reaction to this whale activity is further evidenced by shifts in trader behavior. The taker-buy-sell ratio, a metric that measures the ratio of aggressive buying versus selling pressure, has plummeted to its lowest point since late 2021. According to data analysis from CryptoQuant, this indicates that selling activity has significantly outpaced buying in recent weeks. Such a divergence between price action and underlying demand signals can often precede more substantial market corrections, mirroring patterns observed during the bull cycle of 2021. In terms of market sentiment, the Bitcoin Fear and Greed Index has dipped to 48 out of 100, a score that falls into the neutral category but shows a clear leaning towards fear. This suggests that while widespread panic has not yet taken hold, traders are increasingly adopting a cautious stance and anticipating potential further downside. However, historical data offers a glimmer of optimism for long-term investors. Bitcoin Magazine Pro reports that holding Bitcoin has historically been profitable on an astounding 99.1% of its days in existence, which may provide a foundation of confidence for those committed to longer-term investment horizons. Technical analysts are closely examining Bitcoin's price action to determine its next move. A primary concern is whether the cryptocurrency can maintain support at the $110,000 level or if it will succumb to further downward pressure. The 200-day Simple Moving Average, SMA, a widely recognized indicator of long-term trend health, is currently situated just below $101,000. A breach below this level could signal a more significant trend reversal. Conversely, some analysts, like Axel Adler Jr., have identified potential support zones within the $100,000 to $107,000 range, where short-term holders might step in to absorb selling pressure. The market is also experiencing significant liquidity events, with substantial liquidations occurring. Data from CoinGlass reveals that total Bitcoin long liquidations have approached $500 million since the weekend began, as traders holding long positions struggle to sustain their entries amid the price drop. This has led to speculation about a potential short squeeze. Some market participants believe that if Bitcoin's price can rebound to levels where a significant amount of short-selling positions are vulnerable, it could trigger a rapid upward movement. The $114,000 level has been specifically identified as a potential inflection point where such a squeeze could occur. Despite the short-term price volatility, the underlying fundamentals of the Bitcoin network remain robust. The network's hash rate, a key indicator of the computational power securing the blockchain, is nearing an all-time high, currently recorded at 909,080,589 TH/s. This sustained high hash rate suggests continued strong participation from miners and robust network security. While the immediate future of Bitcoin's price remains uncertain, with the market assessing whether this pullback will serve as a consolidation phase or the start of a deeper correction, the network's fundamental strength provides a degree of underlying support. Audience impact. Traders are expressing concern over the sharp drop and the implications for short-term positions, while long-term holders are drawing confidence from the historical profitability and strong network hash rate. This massive whale sell-off has certainly shaken the market, but what does it mean for institutional investors and their confidence in Bitcoin products? We're about to find out. We're now going to look at the latest data concerning Bitcoin ETFs and what significant outflows might signal. Institutional confidence cracks as Bitcoin ETFs lose $1 billion. After a period of significant inflows that fueled a substantial rally, the landscape for Bitcoin spot ETFs appears to be shifting. Products like the iShares Bitcoin Trust, IBIT, and the Fidelity Wise Origin Bitcoin Fund, FBTC, have been instrumental in driving institutional adoption, but recent data reveals a stark change: a $1 billion outflow from these very ETFs. This significant capital withdrawal signals a potential cooling of institutional enthusiasm and raises questions about the sustainability of the recent market surge. We're breaking down what this outflow means for market confidence and future price action. Bitcoin ETFs, particularly those managed by BlackRock, IBIT, and Fidelity, FBTC, have been a major driver of institutional capital into Bitcoin. However, recent outflows totaling $1 billion indicate a potential waning of this institutional confidence, suggesting a possible shift in market sentiment. The recent rally in Bitcoin's price, which saw it approach $117,000, was largely attributed to the strong performance and significant inflows into Bitcoin spot ETFs. These investment vehicles, launched in January 2024, have collectively amassed over $111 billion in assets under management by mid-2025, becoming a primary conduit for institutional capital. The iShares Bitcoin Trust ETF, IBIT, has been a standout performer, frequently recording daily trading volumes exceeding $2 billion and boasting tight bid-ask spreads of approximately 0.02%. This liquidity makes it a preferred choice for high-volume traders and institutions seeking efficient execution. In contrast, the Fidelity Wise Origin Bitcoin Fund, FBTC, while experiencing lower trading volumes, has attracted long-term investors, particularly those within Fidelity's established ecosystem, including retirement accounts. Both ETFs share a similar expense ratio of 0.25%, positioning them as cost-effective options for Bitcoin exposure. However, their operational differences, such as IBIT's reliance on Coinbase Prime for custody versus FBTC's in-house solution through Fidelity Digital Assets, cater to different investor preferences. While IBIT appeals to active traders due to its superior liquidity, FBTC resonates with long-term holders who value integration within a familiar financial platform. Together, these ETFs have played a crucial role in normalizing Bitcoin investment, offering a regulated and accessible entry point for individuals and institutions previously hesitant to manage digital wallets directly. However, recent market data paints a more cautious picture. On-chain analytics from Glassnode indicate that Bitcoin's Relative Strength Index, RSI, is approaching oversold territory, suggesting potential downward pressure. Furthermore, cumulative selling pressure has intensified, hinting at a weakening conviction among buyers. In the derivatives market, open interest in Bitcoin futures has contracted, while funding rates on major exchanges like Binance have remained elevated despite a declining spot price. This divergence suggests that traders holding long positions are paying a premium for expected rebounds, but if the downward trend persists, the risk of cascading liquidations for these leveraged positions becomes a significant concern. The fragility of the current market is most clearly illustrated by the recent turn in ETF flows. US-listed Bitcoin ETFs, including IBIT and FBTC, experienced a substantial $1 billion outflow, marking a significant cooling in institutional demand after months of consistent inflows. This sharp reversal signals a potential recalibration of institutional strategy and a possible reduction in their exposure to Bitcoin. Complementing this, on-chain metrics such as daily active addresses and transaction fees have also shown a decline in organic network activity. The short-term holder, SDH, to long-term holder, LTH, supply ratio indicates modest short-term trading activity but lacks strong conviction from long-term accumulators. These trends collectively suggest that while speculative repositioning continues in the market, the broader demand base is softening. The market structure, appears to be transitioning from a phase of euphoria to one of cautious consolidation, with investors reassessing the risk-reward landscape. Looking ahead, the trajectory of Bitcoin will likely hinge on whether new liquidity enters the market to stabilize prices, or if the current consolidation phase deepens into a more pronounced correction. The behavior of long-term holders during this period of price discovery will be critical. If they continue to accumulate Bitcoin at discounted prices, it could establish a stronger foundation for a future rally. However, the persistent risk of further selling pressure, exacerbated by elevated funding rates and the potential for leveraged long liquidations, remains a significant overhang. For now, the institutional-led rally appears to be at a pivotal moment, with market sentiment leaning towards caution. Audience impact. Institutional investors are reportedly reevaluating their Bitcoin allocations, while retail traders are closely watching ETF flows for signals of broader market sentiment and potential entry points. These ETF outflows are a clear sign of shifting sentiment, but what's the overall picture for Bitcoin's price action? We've got the crucial numbers. Let's wrap up with a quick recap of all the day's top stories. And that's a wrap on today's Bitcoin Bulletin. We saw massive whale movements signaling potential shifts towards Ethereum. Bitcoin's price recovery is revolutionizing crypto payroll adoption. A colossal $2.7 billion whale sell-off tested Bitcoin at the $110K crossroads, and institutional confidence is wavering with significant Bitcoin ETF outflows. Don't miss out on any of these critical updates. Make sure to hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto news, and ring that notification bell so you're always in the loop. Follow us on all social platforms for more real-time insights. We'll see you next time.